Good morning, ladies and gentlemen. Today we have periodic versus perpetual systems of inventory keeping. Periodic inventory is just what it says. Periodically, we determine the ending inventory. Perpetual means also just what it says. We're going to use a method where we keep the inventory balance on a running basis, continuous perpetual basis. First thing you have to realize is that these are two separate and distinct methods. It's not periodic and perpetual, it's periodic or perpetual. Then when you're working at problems, especially on a test, you're going to be told very clearly whether it is periodic or whether it is perpetual. You have to be told that, but you have to be on the alert for it. Do not take it for granted. I don't know how many examination papers I've graded where the student did a beautiful job of recording periodically inventory, but the problem or the exam question asked for the perpetual method. For goodness sakes, don't make that mistake. Now let's see how it works. In all cases, we're going to have a beginning inventory, assuming this isn't the first month of operation, of course. But we get this information from the accounts. The ending inventory of year 1 or 2 or 3 is the beginning inventory of the next year. Then during the year, we're going to make additions. We're going to buy additional merchandise, which we will call purchases, and adding the two together, we come up with the amount of goods available for sale. Now, at the end of a period, we must, or during the period, we must separate this figure, 800, into an ending inventory and a cost of goods sold figure. This is what our problem is. Let's take the periodic inventory method first. During the month or the period, whatever it might be, as we make additions to our inventory, we will debit an account entitled purchases. This is purchases of merchandise for resale. We debit the purchases and we will credit, of course, cash or accounts payable, depending upon how we bought it. And so during the whole time, we will have made this figure. So under the periodic method, the entries during the term are debits to purchases, credits to cash, and accounts payable. Then, at the end of the period, we make the computation that you've been given to determine it. I won't go into that at this time, but you must understand that under the periodic method, we are keeping running a record of the amount we buy during that term. And that is done in this manner: debit purchases, credit cash, or accounts payable. Over here, on the other side, the perpetual method, that runs a little differently. Now, I presume that many of you, if not all of you, have checking accounts. Now, maybe some of you can write a check and not even bother to look what the balance in the checking account is. I think that's great. I'll tell you what, though, in the Avery family, we never write a check unless we look to see what the balance of the account is. So for us, each time we put money into the checking account, we record it right then, a plus to the balance in the checking account. Then as checks are written, they are deducted so that every day, every time we want, we can look at the checkbook and see what is the balance in that checking account. So we just transfer that. You know how to do that. You have done that. So when we deal with the perpetual method. As we buy material, we don't debit a separate account. We debit an account called merchandise inventory. Inventory set over the period of time, that would have amounted to $700. The credit would still be to cash or accounts payable for the same amount. This is a 0, not a 6. Then, as we make sales, we debit accounts receivable or cash and credit revenue for the sales price. As we make a sale, this is what we've done so far, no problem. But under this method, the perpetual method, we must make two entries. One to record the sale, of course, and the second to record the decrease in inventory. Remember up here in our checking account, up here, when you write a check, you decrease the balance in your account. Same thing here. In this case, we're going to debit cost of goods, because we are making a sale, and we're going to credit the inventory account for whatever the amount of the sale might be. This is going to be at cost. So, under the perpetual method, we make two entries to record a sale. One at the sales price and the other one at cost. Now, of course, we have sales returns and so forth and so on, but that will fall into place if you understand the basics. On the other side, where we're dealing with the periodic method, we do not keep a record. When a sale is made, we would debit accounts receivable, cash, and credit revenue for the sales price. But we do not make the second entry. We do not know how much we have sold during the month. If someone said, how much merchandise have you sold? We don't know, because we don't keep track of it. This, in a nutshell, is how you operate the periodic or the perpetual. Notice I said the word or. Think about this. Hope it will help you understand what you are doing when you are recording inventory. Let me know if this has helped you. Also, please let me know if it didn't and what suggestions you might have for revisions.